joining us today. Your leadership team has been bringing you lots of great information, and this webinar is no different. We have Doug Maletz from Bottom Line Strategies and Management. He is a managing partner and does tax, bookkeeping, and business management practice in Westlake Village. Doug graduated from an accounting degree from Cal State Northridge in 1977 and has spent the next 5 years in the tax departments of 2 national CPA firms and 1 on a local before opening his own practice. The firm began in 1981 as a one-man office and now has 10-member staff and continues to grow. Half of his team is a professional staff, 4 CPAs, and Doug is an enrolled agent, a national tax license issued by the U.S. Department of Treasury. Annually, he prepares over 2,000 tax returns for individuals, sole proprietors, LLCs, partnerships, S Corps, C Corps, trusts, estates, and nonprofits. So with that, Doug, I'd like to welcome you to the Zoom and thank you so much for taking your time today. We really appreciate you.
Well, good morning and thank you for having me over. So to reiterate what Karen said, my name is Doug Maletz and I'm the managing partner of Bottom Line Strategies and Management. And we are a full service tax, bookkeeping, and business management practice here in Westlake Village. We've been serving the Conejo Valley since 1982. We are the quintessential neighborhood tax practice. Our clients run the gamut from earning very little to earning several millions of dollars per year. Our clients are self-employed, employees, investors, and retired folks. And as Karen alluded to, we prepare approximately 2,000 tax returns per year. In a word, we're a community tax practice. This morning, I'm going to attempt to dumb down some sophisticated concepts for you. The goal is not to answer all of your questions on these subjects. The goal is to make you think about your own situation and your client's situations, and to get you to a place where you understand the challenges each of you confronts when trying to limit your tax liability, and to give you a basic foundation for asking your own tax professional, or those of us at Bottom Line, appropriate questions to help you strategize a better outcome. My goal this morning is not to give you answers to questions, but rather to give you perspective. The first thing we're going to address this morning is basic individual tax history and theory. Don't groan, it all goes to perspective. So tax history. The individual tax return is barely more than a century old. The first major tax act came down at the beginning of the 20th century, courtesy of Woodrow Wilson, sparking the first tax returns that appeared in 1913. The returns were mere 3 pages long, with 1 page of instructions. It was a one-shoe-fits-all return, and the gist of the thing was, tell us how much you earned, and we'll tell you how much to pay. It required no energy, effort, or risk on the part of the taxpayer. It was very simple. But this whole thing went through a major rewrite in 1934 under Franklin Roosevelt. 20 years later, it went through another major rewrite under Dwight Eisenhower in 1954, and that was the tax law of the land for the next 32 years, until Ronald Reagan gave it a major tweaking in 1986. Reagan's tax code is the one that we are all used to because it was in place for 31 years until December of 2017, when Donald Trump rewrote it once again. And because Trump's tax code is only 3 years old, many of us and our clients are dealing with decisions and memories of decisions made under Reagan's tax code and how they mesh with Trump's new tax code. So let's get to tax theory. When we at Bottom Line get into a client's tax responsibilities, we first take a holistic approach towards the client and work to get to know who they are. This enables us to ascertain their level of risk as it pertains to tax-related investing, earnings, and spending. When we consider their risk in these areas, we picture the client on the baseball field of life. Home plate represents the no-risk part of their life. First base represents the low risk part of their life. Second base represents the moderate risk part of their life. And third base represents the high risk part of their life. The no risk person is more often than not unmarried. They generally get up in the morning, eat their cereal, go to work, come home, nuke some dinner, watch some Netflix, and then go to sleep. And that's their day. That's what we accountants call a short form. The low risk part of a person's life generally relates to community. These people are generally married with children. Occasionally, they're responsible for one of their own parents or more, and everybody's medical expenses. These people need to put a roof over everyone's heads, so they purchase principal residences that come with mortgages and property taxes. They give money to their church or synagogue, local charities, Red Cross, and they give old but good stuff to Salvation Army and Goodwill as they purchase new stuff for themselves. These are people who itemize their deductions. Moderate risk is all about investments. Does an employee have a 401k or 403b or a traditional or Roth IRA? Does a self-employed person have a SEP IRA, a 401k, or a defined benefit plan? Are they earning interest income, dividend income, or capital gains? Are they investing in tax-free municipal bonds or treasury notes? Are they going the distance and buying rental real estate? And then last but not least, there's the high-risk component to a person's life, namely, are they self-employed? So given this, from the perspective of the United States Federal Income Tax Code, if you want to be the best American you can be, you're living your life in all three of these areas. You own your own business, you're putting away money for retirement, investing in corporate America, the government, rental real estate, you're raising a family, putting down roots by owning a home, and contributing to local charities, and by doing so, building community. And one of the wonderful things about being an American is you can do all these things, some of these things, or none of these things. The choices and challenges are yours to choose from and contend with based on your choice of lifestyle. But from the perspective of the tax code, they indicate the level of your tolerance for positive risk-taking, as well as the amount of energy and effort you're willing to put out. And this directly correlates to the size of your tax liability and how much you pay in taxes. The tax code has traditionally rewarded positive risk-taking. The business person has a better outcome on their tax return than the investor, who has a better outcome on their tax return than the community person, who certainly has a better outcome than the no-risk person. No matter how much or how little you know about taxes, every single one of you knows the three most important words on a tax return: adjusted gross income, or AGI. It's the magic line on the tax return responsible for literally opening or closing doors for your clients as well as for yourself. Life above the line is very dynamic as opposed to life below the line. Gross and net income from work, self-employment, and investments all happen above the line. High and moderate risk happen above the line. Community, low risk, and no risk happen below the line. Up until the end of 2017, the distance between the four components of risk was pretty evenly dispersed. Trump's Tax Act changed that significantly. The gap between no risk and low risk narrowed dramatically. And the gap between moderate risk and high risk narrowed dramatically. Last but not least, the gap between life above the line and life below the line expanded considerably. If your life above the line is limited, so is your ability to influence your tax liability. Prior to Trump's 2017 Tax Jobs and Cuts Act, you could deduct mortgage interest below the line in your itemized deductions on one principal residence plus one second personal residence on mortgages up to $1.1 million. If that was in effect prior to December 16, 2017, Then you're grandfathered into deductibility on the first $1 million of mortgage. So you only lost the interest on the last $100,000 if you had that much. But if you purchase the home after that date, you're limited to deducting interest on only the first $750,000. On top of that, prior to 2018, you could deduct all of your property taxes on personal use real estate, your DMV fees, and your California tax. After 2017, you can only deduct up to the first $10,000 in that area. In 2017, the no-risk person with little or nothing to write off on his itemized deductions got a standard deduction of $6,350. And if he was married, he got $12,700. This year, under a Trump tax code, single people will have a standard deduction of not $6,350, but $12,400. And married people will have a standard deduction of not $12,700, but $24,800. The standard deduction practically doubled. Say you have John and Mary who took on some risk and they own a condo and they've got $24,800 in mortgage interest, property taxes, and charities. And they live next door to Phil and Judy who are renting the exact same condo. Phil and Judy took on no risk and get the same deduction on their tax return. It's a big deal. The gap between low risk and no risk narrowed dramatically since the end of 2017. Phil and Judy have less reason to buy a home and put down roots in their community. And if they buy anything, it's more likely to be something where they can toggle between a vacation home versus something they can Airbnb. Rentals don't have the same restrictions on mortgage interest and property tax deductions that principal residences now have since 2018. And rentals can now get some of the benefits as businesses, same benefits. There are three taxes that most of us have to contend with: state tax, federal tax, and self-employment tax. Personal deductions like mortgage interest and charities will reduce your state and federal taxes, but only business expenses will reduce all three taxes. Bottom Line prepares tax returns for quite a few realtors. I provided a copy of our schedule of common realtor deductions to our host Karen, who will share it with any of you who are interested. Like any responsible business owner, you should maintain a real set of books, whether you're a Schedule C sole proprietor or an S Corp owner. You should keep a separate checking account and credit card for your business. Keep your receipts, canceled checks, bank and credit card statements for at least 4 years. Be mindful when you're shopping as to whether an item you are purchasing can be construed as being related to your business, and make sure it lands on the right credit card. If you need to split up your shopping into 2 separate credit card transactions, personal versus business, do it. IRS's standard for a deductible item is whether an expense is, quote, ordinary and necessary, unquote, for your business. Self-employment tax is one of the biggest reasons realtors look at forming S corporations. Many realtors operate as sole proprietors, which means they report their business income and expenses on their individual tax returns on Schedule C, which is a profit or loss from a business schedule. Some realtors wrap their Schedule Cs in something called a single member LLC. This is basically applying a cellophane layer of protection against lawsuits to your business, but it doesn't change your tax liability. In your previous life, when you worked for someone else, that company withheld 7.65% of your paycheck for Social Security and Medicare. Your employer matched that amount, so the government got 15.3%, half from you, half from the employer. When you're self-employed, you're responsible for the entire 15.3% of self-employment tax on your business income after business deductions. So becoming an S corporation can help mitigate this tax, as well as help audit-proof your return. So who should not be an S Corp? First off, realtors with a track record of low earnings. There's an expense that comes with being an S Corp, and it's likely to exceed the tax savings for a realtor with low earnings. The state of California gets a minimum of $825 per year. You need to maintain a set of books and minutes. You need to prepare a corporate tax return and quarterly payroll tax returns. You need your finances to be organized. And then there are the attorneys. They'll incorporate you for an average of $2,000 to $3,000, unless you go to something like CorpNet in Westlake Village, but you'll do it for around $600, or LegalZoom. Another reason not to be an S Corp is if you have family members between the ages of 13 and 17 that work for you. You can get a tax benefit that you cannot get as an S Corp. When a family member under the age of 18 works for you, you can issue them a W-2, and you don't have to withhold Social Security or Medicare tax or make the employer match. For example, if you paid your son, who was between the age of 13 and 18, or 17, $12,000 in the year 2019, they would have zero in Social Security tax, zero Medicare tax, zero federal tax, and only $75 in state tax on $12,000 worth of income. But you get a $12,000 business deduction. If you're paying 22% federal tax, 9.3% California tax, and 15.3% self-employment tax, that's 46.6% of $12,000 you're saving, or $5,592 per child. That's a chunk of change. And if you're in an even higher tax bracket, it's that much more. Of course, this all ends the year that they turn 18, but it's something to be mindful of. Conversely, if you have a track record of a healthy income, an S corporation is probably a serious consideration for you. S corps have a much lower incidence of audit than Schedule Cs, so you can generally be somewhat more aggressive with deductions. S corps also offer limited liability protection, similar to LLCs. Every realtor carries E&O insurance, and being an LLC or an S corp is not a reason to cancel that insurance. But it is an extra layer of legal protection that ensures that if somebody does sue you, the most they can recover is the value of your LLC or S corp. They cannot reach beyond that to your other assets. By the way, this is why attorneys will recommend that you or your clients wrap each of your rental properties into individual LLCs. If you put them all into one, a person suing the LLC can collect up to the value of your LLC. And by aggregating your assets under one umbrella to save a little money, you've inadvertently increased the value of your LLC and accordingly your exposure. Every corporation begins as a C Corp. You have to elect S Corp status. If you want to incorporate for 2021, you will likely want to do so during the last 14 days of 2020. This will avoid a tax filing for 2020 and get you up and running immediately for 2021. An S Corp files its own separate tax return, pays no federal tax, and minimal California tax. The net income flows through to your personal tax return via summary amounts. Now, S Corps need to pay their owners reasonable compensation. That amount is subjective. The maximum earnings subject to Social Security tax for 2020 is $137,700. And for 2021, it's going to be $142,800. So if you gross $400,000 and spend $75,000 to do that, netting $325,000, reasonable compensation should be at least the $137,700 for this year or the $142,800 for next year, the maximum Social Security level. But there's no compelling reason to make it higher, and that gives you an opportunity to save on some self-employment tax, especially if you have employees, because their duties will help justify a lower salary for you, which will increase your K-1 income. Even at lower levels, there's plenty of play with self-employment tax. So from an S Corp, you'll get a W-2 and a K-1, K-1 showing your net income. And that K-1 net income is not subject to self-employment tax. Keep in mind, you will likely want to be applying for Medicare when you're 65 years old. That requires at least 40 quarters of minimum income of roughly $1,500 per quarter. Be mindful of that, since a lot of S Corp owners get lazy and only pay themselves salary in the last quarter of the year. You don't want to get to 65 after making good money for 30 years just to learn that you've paid into Medicare 30 quarters worth because you paid yourself only once a year when you could have paid yourself 4 times a year. And Medicare doesn't work like Social Security. If you have a non-working spouse, they will collect Social Security based on half of your benefits. So if you collect $2,000 per month, they will collect $1,000, and the two of you together will collect $3,000 per month. Medicare does not work that way. Each spouse needs to pay in. So if you have an S Corp and a non-working spouse, you should consider hiring and paying that spouse a minimum of $1,500 per quarter to ensure that they also qualify for Medicare when the time comes. I mentioned earlier that IRS's standard for a deductible item is whether the expense is, quote, ordinary and necessary for your business. This forces us to be mindful of the 2018 landmark California Supreme Court decision known as Dynamics that adopted new pro-employment standard, the ABC standard, which presumes a worker is an employee versus an independent contractor under California wage orders and regulations. Assembly Bill 5, otherwise known as AB 5, was passed by the California legislature in 2019, codifying the ABC standard. Under the ABC standard, the worker is presumed to be an employee. To have a worker classified as an independent contractor, the hiring party must show 3 things. A, the worker is free, both contractually and in practice, from control and direction on how to perform a service. B, the worker's service is outside the hiring party's usual services. And C, the worker has an independently established trade, occupation, or business of the same nature as the work being performed. The effect of Dynamics and AB 5 is that the ABC standard entitles workers to all the rights and benefits of employment, unless the hiring party can meet the ABC standard to prove the worker is an independent contractor. These lead to higher costs for labor and potential legal risks for hiring parties. So what does that mean to you as realtors? Under these laws, you are exempt from being considered employees. You are definitively independent contractors, even though you're being paid by one specific brokerage. That's the good news. The bad news, you have to be extremely careful about the people you or your S Corp hires to work for you. If they look like an employee, taste like an employee, and smell like an employee, they're an employee. And you'd best put them on payroll rather than pay them as a 1099 independent contractor. If one of these people get into a car accident while performing a duty for you and they're not on payroll, or you come to a parting of the ways, they can take action against you via the United States Labor Department or the California EDD. They can sue you for payroll taxes and lack of workers' comp insurance, and IRS and Franchise Tax Board can deny your tax deduction. Don't mess with this one. It's really a hot item. Likewise, if you do use the services of a bona fide independent contractor, have them fill out a Form W-9 from the get-go so you can issue them a 1099. If you don't, you'll lose the deduction in audit. Additionally, if you or your clients have rental properties and want the same tax advantages businesses now have under new tax law, you must now 1099 all independent contractors. Plumbers, electricians, handymen. Same thing holds true when you as realtors pay these people to fix up your clients' homes to ready them for sale. Filing a 1099 ensures IRS that the person whose services you're trying to deduct are picking up the income on their own tax returns. If you fail to file a 1099, IRS assumes the person you paid has not reported the income and they will disallow your deduction. The exception is if these people are corporations. You don't have to 1099 them. The last topic of the morning is PPP money. To parody the British poet Alfred Tennyson, "'Tis better to have a loan and be taxed than to never have had a loan at all." Many of you have received payroll protection program monies this year. If the money loaned by SBA was spent in a prescribed manner, you don't have to pay the money back. The loan will be forgiven once forgiveness is applied for. But you should have all heard by now that at the moment, unless Congress acts soon, IRS and the California Franchise Tax Board considers this money to be taxable in 2020. Now, if you want to be technical, the loan itself, when forgiven, isn't taxable income. But the expenses you paid for the monies in a prescribed manner aren't deductible, which means, in essence, the loan is taxable. IRS let Congress know this shortly after the program began, hoping Congress would address this issue. To date, they have not. It is widely believed that Congress intended for these monies to help small businesses and therefore never intended for IRS to follow long-standing rules in this particular instance. We are so hopeful that when Congress reconvenes in January, that they will fix this in the next coronavirus aid package. The House's version of the bill has a provision allowing deductibility of these amounts. But at the moment, you should budget for this money being taxable, and you should make your estimates accordingly. One more time, right now, expenses paid for in a prescribed manner of PPP loans are at the moment not deductible in 2020 on federal tax return. So if you have an S Corp, your corporate tax return is due March 15th rather than April 15th, unless you put your return on extension until September 15th. If your S Corp received PPP monies, you should consider going on extension this year until Congress addresses this issue one way or another. In closing, realtors and their clients have many opportunities to manage and influence their tax liabilities. But you have to be mindful of A, the law changed since 2017, B, the manner in which your risk tolerance and related choices affects you, C, how you might benefit from operating your business as an S Corp, D, whether your independent contractors are really employees, and E, how much PPP money is treated on your personal and corporate tax returns. There's a lot going on with these issues alone. If you're overwhelmed, my firm, Bottom Line Strategies Management in Westlake Village, is here to help. Thanks for listening. I hope it was worthy of your time.
Thanks so much, Doug. There is a couple questions. Well, first of all, Christy Rickert said you're the best. She's been working with you since 2004.
Thank you, Christy.
Yes, of course. And then there was another question about what is a healthy income amount that you had mentioned.
Well, generally I wouldn't consider or wouldn't recommend to somebody to think about becoming an S corporation if their gross income is under $50,000. I'd rather it be closer to $100,000 or more. But as I said, it's a lot of money to fork out just to become an S Corp and to maintain it.
Exactly. Well, tell everybody where they can find you and how they can call you if they have a question. And again,
Karen,
thank
do
you.
you want to open up for questions? We do. Yeah, if you want to unmute yourself, just click on that mic and you can ask any questions. If we want to just open it up for a few questions here, we'll give it a few minutes maybe.
Okay.
Sure. Anybody?
Robbie Starr has said, Doug has helped me greatly love.
I had a question.
Thanks, Robbie.
Go ahead.
Can you become an LLC and then later change for an S corporation once the income increases?
Yes, you can. You can. Now, an LLC is pretty easy to become. You probably also want to use something like a CorpNet or LegalZoom to become an LLC. But because it's cheaper, unless you want a long-term relationship with an attorney, and that's not a bad idea either, especially if you're going to be picking up employees along the line. But an LLC is something you can do pretty easily. You're still going to have the minimum tax of $800 per year to the state of California, and then the Secretary of State gets $20, I think, every 2 years on an LLC. So you've got, and there's a very small tax return that's it's pretty easy for us to do that goes along with the tax preparation package. So we do a federal return, a California return, your standard federal and California, and then the LLC gets a very small tax return. There's a potential tax that's based on gross earnings on an LLC. So you can get to a point where I think if you're grossing over $1 million, it's $6,000 of additional LLC tax. You're not really getting any benefit for that. So at that point, you'd really prefer, even well before that point, being an S Corp. So you get out of that tax and you get some additional benefits.
Great. There's another question, Doug. Is there a cheat sheet that you can give us for guidelines on LLC versus S Corp, pros and cons?
There probably is. I'm sure that they're out there. I could probably rummage one up for you.
Okay, great. I also have a tax deduction sheet for all of us that I will email you that shows all of the different tax deductions that we can use in 2020. So Doug, again, give everybody a phone number where they can reach you and where you're located.
Our phone number is area code 805-230-1313. And we're in Westlake Village at 31365 Oak Crest Drive, and we're in Suite 200. Again, that's Westlake Village. It's not too far from the corner of Lindero Canyon and Agora Road.
Great. Thank you so much for your time today. We appreciate you so much.
Thank you for having me in.
All right.
Take care.
Thank you.
Thank you, Katie. Hey, Christy, thanks.